Hello, everyone. Welcome. This is Si Wing Yi from the Yi Real Estate Network, and welcome to how to use your self-directed IRA with a non-recourse loan. And our special guest is no other than Roger St. Pierre from First Western Federal Savings Bank. His company is one of the few top non-recourse lenders with the IRA in the country, and there's not too many people or company doing this efficiently and what have you. So I've known Roger for a while now, and we cross paths quite often over the years, and because we are in the same industry, same thing. We are specializing in real estate investing across the country. So and yeah, so I know. We intend to do more business this time. So now that I found you again, and your company and your services is a perfect fit for our turnkey out-of-state real estate investors. Most of us, our members are from California, Northern California, San Jose to be specific, but we do real estate investings any location in the U.S. And anyway, so without further ado, Roger St. Pierre, again, he's going to do a presentation. He's going to talk about the the power of leveraging using a self-directed IRA, using a non-recourse loans to stretch your IRA to purchase more properties, higher return. So real estate investors using their IRAs to so they can achieve financial freedom and retirement as quickly as possible and live out the rest of their life and never run out of money. At least that's our hope. All right, so without further ado, Mr. Roger St. Pierre, take it away, my friend.
Thank you so much, C Wing. It's been a great opportunity to get together with you and also to be able to present the topic of non-recourse lending and how to leverage the money and properties that are already in your IRA to buy more properties and hence get greater returns and build that IRA up into a powerful income producing asset. Just a little bit about me. I'm Roger St. Pierre. I've been with First Western Federal Savings Bank about 21 years now out of a 35 or so year banking career. Our bank went into the non-recourse space specifically in 2008 to provide leverage and service of non-recourse loans for IRAs, self-directed 401ks throughout the country. So for the last 11 years, I've spent my whole focus on non-recourse lending, both educating investors around the country and then providing the loans and the leverage that people need to maximize their IRAs. So a little bit about First Western Federal Savings Bank. We're a portfolio lender. The bank has been around since the late 1970s. We've never sold a loan, and we keep every single loan that we make on our own books. So we are a true portfolio lender. And we specialize exactly on lending to investors. And today's topic will be on non-recourse lending, but we also do make loans for other real estate investors who are using their own money or LLC money to purchase real estate assets for investment purposes. So a little bit of a disclaimer here. We're not accountants nor investment advisors here at First Western Federal Savings, and we're not qualified to provide advice on IRA rules, regs, or eligibility requirements. So please consult your tax and investment advisors before you make these investments to be sure that they're lining up with your goals and what you want to do. So start out number one, what is a non-recourse loan? A non-recourse loan is simply a loan that is secured by the asset property, and should there be a default on the loan, the bank has no recourse, hence the term non-recourse, to collect the balance of the loan from either the self-directed IRA or 401k or the owner of the 401k or SDIRA or 401k trust. So the idea is, and that was built into the IRS regs back in 1974 when they created the IRA. They said in that time and put it into the federal code that should an IRA or 401k borrow any money, the only way it can be borrowed is on a non-recourse loan, where the owner of the IRA or 401k cannot provide a personal guarantee. The whole idea is that the asset stands on its own. It produces enough income to pay the loan back without having to engage the owner of the IRA or other assets in the IRA to make those payments and pay the loan back. So ultimately and basically, it's a mortgage loan, just like any other mortgage loan you may have, but this is a true non-recourse loan. And I should mention that in California, most home mortgages are non-recourse, but you also sign for those mortgages personally. These loans you do not sign for. Your custodian, if you have an IRA, actually signs as the borrower, or if you're using an IRA LLC structure or 401k structure, you're signing as a trustee, but you're not signing personally for this money. Your IRA or your plan is truly the borrower for this loan. And what kinds of entities are acceptable? Well, basically any kind of approved self-directed retirement plan. That could be a self-directed IRA, whether it's traditional, it could be a Roth IRA, inherited, separate, simple. You could have a solo 401k trust. Could be an IRA LLC, either a single member where you as the investor, you have your custodian as the member in an IRA LLC, and now you're using your LLC to purchase real estate. Could be a multi-member IRA LLC. Let's say 2 or 3 investors get together with their IRAs, become members in an LLC, and then use the LLC as the purchasing and entity vehicle to buy and hold property. 401k trusts, also checkbook IRA. So basically any kind of approved self-directed pension plan, IRA, solo trust is an acceptable loan for a non-recourse, or acceptable entity, pardon me, for a non-recourse loan. And our bank will lend on basically any investment property for the most part. There's a few exceptions, but basically any kind of residential, that's single family, multifamily, condos, apartments, it could be any number of units, duplexes, triplexes, a 10-unit apartment building, for example, we lend on. Also commercial buildings, could be office buildings, it could be office warehouse, could be industrial space, could be retail, office buildings typically. So we'll lend on commercial, and then we also lend on ag. In other words, if a real estate investor specializes in ag land and has a very good feel for that asset, he or she may purchase a property with his or her self-directed IRA, and then lease that ag land out to a farmer who's going to grow crops and pay him annual rents. So basically the idea is a property that's a buy and hold, that's going to be kept for several years, and is going to be an asset purely for investment properties, not for personal use within the IRA. That's a property that our bank can lend on. So you're asking, what really is the qualification? Since I'm not the borrower as a person, how do we qualify for one of these loans? Well, it's pretty straightforward and very simple. Since you're not the borrower as the investor, we don't look at your tax returns or financial statements, your other assets personally, because you're, again, not the borrower. We simply look at the balance of the funds in your IRA or 401k bank account, and is that enough? So we start with the money. Show me the money. So does the IRA have a typically 40 to 50% down payment? In this world, because it's non-recourse, you'll find that down payments are considerably higher than standard Fannie Freddie investment property loans. So we require a minimum 40% down. There's some properties that may require 50%. So think in terms of about a 40% down payment, having closing costs in your account like you would on any kind of a real estate purchase, and then having some reserves left over on the sidelines so that there's always a pool of operating monies to pay loan payments in times of no tenants, or let's say you've got to do a repair on the property. Again, when Joe the plumber comes over and hands you a plumbing bill for $1,500 for a water heater, you can't just reach into your hip pocket and pay them out of personal funds or a debit card. that payment has to be paid for simply by the IRA or solo K entity, whatever, that owns the property. So there has to be some operating monies left over, liquid, to be there. So that's where that 15% of loan amount comes in.
Roger,
So
I do have a
again,
question.
yes, sir.
Roger, the 15% loan amount minimum reserves, does it have to be inside the self-directed IRA, or can it be on another bucket of IRA money that are not self-directed yet?
Now that's a
Maybe.
good question. Our bank takes the position we want it in the same IRA entity that actually owns the property. So if a person has a custodial held IRA, we want the 15% in there. They may have other IRAs somewhere else, or maybe some money over at Schwab or Fidelity. But I can't count those as reserves if that money is not actually sitting in the IRA. Now, here's a clarification on that idea. We do count not just cash, but any liquid investment. Could be stocks, bonds, or mutual funds. So if you have a trading platform within your self-directed IRA where you are trading stocks, bonds, and mutuals, those all count as towards the liquid reserves. But to clarify, the entity that buys and owns a property is the entity that we'll want to see the reserves in. Secondly, then, is how is the loan going to get paid back? It's been from the cash flow of the property. So will the property have sufficient cash flow? I'll get into that in a minute, how we measure that cash flow, but we're looking at positive cash flow after all expenses being available to pay the debt from that asset, not from other assets within the IRA. Is the property rent ready, or nearly so, and in a good location? We have a $10,000 parameter, let's call it, on repairs that could or needed to be made prior to making it rent ready. And what I mean by that is we have a lot of investors that are buying properties that have been seller occupied. They've never been a rental before. And oftentimes those properties need a little bit of TLC to dress them up just to make them ready to rent. Maybe new flooring, maybe some new appliances or interior paint. We're okay with closing a loan on a property that needs a little bit of work like that, with the idea that you would have money available in your IRA after closing to go do these minor repairs in flooring. So anything up to $10,000 that's needed to make a rent ready, we're okay with, as long as you get that repair done within 60 days. So the property basically has to be rent ready or nearly so. We don't want to finance a fixer or a fix and flip. We're not in that market. We're in the buy and hold segment of this market. So we're looking for rent ready property. Lastly, does the property make sense for your SDIRA or 401k? And that's just more of a global thought. Does it really make sense for where you're going in your retirement plan? Does it make sense? But I want to back up just a quick second here. I mentioned something about fixing up properties that maybe need a little more work. Not only can we do purchase money loans that we fund when you buy the property, we can do cash out refinances. And we do this quite a bit, where someone, in order to get the deal, they really do need to pay cash. Otherwise, their offer is going to go to the bottom of the stack of 8 or 10 offers. So a lot of times I work with investors who are using cash out of their IRA to just go ahead and buy the property outright. If there's other improvements that they need to make, they're going to do them with that same pool of IRA money. Then they come back to us after it's rent ready and they already own it and say, hey, I want to do a cash out refinance. We would like to put cash back into our IRA, and we can do that. So I just want to clarify, not only can we do purchase money loans, we can do cash out refinances. And I'm doing a lot of those actually for investors who bought property back in, 10, 11, 12, 13, when housing prices were quite a bit lower than they are today. They paid cash because they needed to get the deal done. And now they may own 3 or 4 properties free and clear. And that same investor is saying, but I want to buy more. How can I get more money? Well, here's a way to do that. You can tap the existing equity in those properties already owned in the retirement plan and we can lend up to 60% of your purchase price, or in some cases appraised value if you've owned it 4 or 5 years, and put that money back into the account. So I bring that up because there are some of those properties that if an investor really wants, they may need more than that $10,000 worth of work to make it rent ready. I suggest, and I see often, where the investor just goes and buys the property for cash, does the improvements, then comes back to us for the cash out refi. So we could work with that kind of an investor and property as well. How long does this process take? Generally 24 to 48 hours to get a loan decision out of us. And then once a decision is made, if it's yes, we collect an appraisal deposit and then order appraisal, title work, and close. Normally 2 to 3 weeks after that, we're going to be closing. I would say, I don't want to overpromise, so I usually say around 30 days after appraisal deposit we'll close. But generally, it works best if I have an opportunity to pre-screen a property. And what I mean by that, for you investors out there who are looking at properties, if you see something that you really are interested, do you think it's probably going to be a good fit for your portfolio, I'd like to have you email me a link to the property so I can review it online. Give me a little bit of your sense of the income and expenses it's going to have so I can gauge some cash flow. And if all that looks good, then I can encourage that investor, if they so desire, to go ahead and put that property under contract. My whole deal here is efficiency and saving time. I just don't want to be taking loan applications on properties that we're not going to get to the finish line on. So I really like to work with you investors out there, see what you're seeing, work with you to find properties that are going to fit not only your portfolio, but fit our loan program, so that when you do go to put them under contract, you have confidence that it's a property that we can probably get the loan done, or have a high degree of probability it will get done. And in speaking of that idea as well, we can also write a pre-qual letter to go in with your offer. And basically all I need is 3 things to do that. I need a link to the property so I can do some basic review on that online. I'll need a quick pro forma income and expense as you see that property performing, and then a copy of your IRA statement or bank statement where you keep your funds. And as long as I have the ability to look at that information, normally within about an hour, hour and a half, I can spin around a pre-qual letter. So let's say you wanted to put an offer in on something later this afternoon or this evening. You could send me over a copy of your IRA statement, link to property with some income and expense, and I could produce a pre-qual letter so that you have that to go in with your offer later in the afternoon. And again, remember, I'm pre-qualifying the entity and the property. I'm not pre-qualifying you, the person. So this process is a bit much not like or unlike when you're going to get a pre-qual letter on a personal deal. In that case, you hand the lender your tax returns and credit report and all that, and you do a financial statement. They say, okay, you're good to go for $300,000 or whatever the number is. In this world, you as the person, you're not pre-qualified for anything. What we're doing is we're pre-qualifying the property, because that's the asset that we're going to hold on our books for as long as you keep the loan with us. So it's really all about the property. So just a thought there, we can do pre-quals letters, help get properties under contract, so that by the time we get an application, we're both fairly well on the same page and going down a track that we should be able to get to the finish line on. What are some things that could derail or sidetrack a loan? A couple things here right off the bat is overestimating rental income. Let's say you're estimating getting $2,000 a month out of a given property. We write the whole loan based upon that $2,000 a month. And that's all well and good until we come down and have the appraisal done. And when we do our appraisers for this, or when we hire appraisers for this sector, we always have them get us a rent comparable survey. We have the appraiser find a minimum of 3 comparable rentals in that tight neighborhood to the subject property, and from that derive market rent. And it all works good if you as the investor haven't overestimated rental income. Where the process falls down is, let's say you've estimated $2,000 a month rental income, and in reality, market rent's $1,500. We as a lender will defer to that independent third-party appraiser and use that appraiser's $1,500 a month rental income, not your $2,000 that you projected. And if that $1,500, that thing no longer produces positive cash flow, then we can't do the loan. So my point here is, do your homework. When you're looking at buying properties out of state, anywhere, and oftentimes investors are buying in locations remote from where they live, I just recommend, and can't strongly say enough, to do your due diligence and get good market data so that there are no surprises and that you're realistic going in on what you think that can rent for. Another thing that can wreck a deal is having a whole bunch of low-priced properties around the subject property that's priced substantially above them. I'd much rather finance the least expensive property in a nicer neighborhood than an expensive property, the most expensive one on the block. Because should I get that property back, I don't want to be competing against properties that sell for 60 or 70% of what this asset is trying to be sold for. So again, particularly if you're buying properties that have been already improved, potentially turnkey properties that have already been improved by a seller, they may be the most expensive property on the block. And all I ask is you do your due diligence, because if that's the case and everything around it is selling for much, much less, even though it may not have been improved to the same level, it's going to be very difficult for us to get the loan done. So just a word to the wise there. Make sure that the value you're buying is equal to the value of the properties around it. High crime areas is a real tough thing to work with, because that never goes away. I mean, you can paint a house if you don't like the color, but you can't change the crime. So high crime, it impacts how long tenants want to stay. It impacts resale value, as in probably there won't be any additional appreciation. It's harder to keep tenants. High turnover means less income. So high crime areas are something that definitely is a showstopper for us. And we look at 2 or 3 different sites that have crime data, and you can too. There's a bunch of them on the web, and they will give you a grid and show you what kinds of crime, the level of crime that's in a certain area for a specific address. Poor condition of the property. You may have a foundation that's got issues, bad roof. A bunch of different things obviously can equal poor condition. What I'm talking about there is in excess of that $10,000 in repair to make it rent ready. So a property that's more of a rehab type property, we won't lend on. Another idea here is global debt service. Not only do we take into account the debt service covering you on our loan, but if you have other loans out there on your non-recourse, specifically, not personal loans I'm talking about, but other non-recourse loans through your IRA or solo K entity, we have to take those into account and make sure that globally or across all loans that there's sufficient cash flow from all properties to service that debt. And if there is not global positive cash flow, then we may not be able to make a loan on a subject property, even though that specific property is a positive cash flowing property. Maybe there's 2 or 3 other properties in the mix that don't do so well. They can bring down that overall debt service and impact that. So just be aware of that if you've got multiple loans out there, multiple non-recourse loans I'm speaking about. We just want to make sure everything cash flow is positive. Lastly, I touched on that earlier, is that inadequate reserves. We just want to make sure that you do have reserves there too, because if we're making a loan, that's nice. We want to see the 15% of loan amount reserves for our loan. But if you have loans with other non-recourse lenders out there, we want to see reserves to cover those loans as well. So we're going to look at kind of your global reserves and make sure that you have them to cover your whole portfolio of loans.
Roger, I'm sorry. I do have a question for you.
Sure.
Sorry to.
Anytime. No, anytime.
Yeah. Anyway, I'm my company, my network also represent, although, we represent good new constructions in Central Florida and in Texas, that's no problem because we do have some markets that we're presenting in Midwest. Let me give you one example in Buffalo, New York, where we've been doing a lot of business in this past year. And however, those properties are very, very old, built in like 1920s, 100 years ago. However,
Yeah.
I'm happy to say that those properties are completely rehab and very, very turnkey, and the tenants in place, and all the. So that's really very, very good property, very high cash flow, and blue collar, a working class neighborhood, low crime rate. So those properties are anywhere from single family home like as cheap as 35,000, maybe 40,000 single family homes in Buffalo, Niagara Falls, but they have a good, and also duplex like 50 to $80,000 duplex, and triplex like $100,000. But again, they have been rehab very, very nicely, and turnkey, and have a long rental history associated with those neighborhoods. So with that said, you be able to do non-recourse loans in that particular market, given what you.
So I don't have any issue with the age, C-Wing. Here's a little bit about our lending parameter. We like to lend on properties that are built 1940 or newer, as a general idea. However, I can lend on a property built older than that. Let's say it's built in 1900. There's a lot of areas toward the East Coast where everything out there is, built in the 19 teens, 20s, whatever.
Right.
They're old in the sense that they're more than 100 years old or so. We can lend on one of those properties if the borrower provides us with a home inspection. And it's basically a home inspection. Normally they cost about $300 to $400 that I see in most markets, somewhat less. And as long as that home inspection reveals that everything is solid, like the roof is good, foundation, plumbing has been updated, electrical is now all on circuit breakers instead of knob and tube. So in other words, if the property, though it may be old, has been updated, we can lend on it. What I will clarify is the idea you brought up some properties that were $35,000, $50,000, $60,000. Here's the deal. We have a minimum loan amount of $40,000. And in most states that we're going to lend up to 60% or some cases 50% on turnkey, that would tell you that the purchase price has to be at least $80,000 or more. Because if I'm going to get a $40,000 loan out of it, and I've capped my loan at 50%, that means purchase price has got to be 80 on up. And that would be on a single family house. If you're buying a triplex, I'm probably going to want to see a price up there around 150, because I want to see that per door cost if I'm looking at multifamily in at least the $40,000 to $50,000 range per door. Since I have at least an $80,000 cost per door on single family, if I'm in multi, I want that thing to be up around 50K. One thing I would say also is in New York State, New York has some brutal lending laws, and it's just nearly impossible to collect a loan if it goes south. So we don't want to have loans going bad in New York State. We will lend there, but we lend at 40% of purchase price. So a property would have to cost $100,000 in New York State for us to make a loan on it of $40,000. So be aware of that. Single family costing at least $100,000. If you're going to do multifamily in New York State, they probably better be around $150,000 or more, so that we have our price per door in that $50,000 range or better if it's multifamily. So just something to be aware of. We can lend on older properties. We can lend in New York State. But the property price point is going to have to be there around $100,000 or more. And if you're buying turnkey stuff, generally, we're a 50% lender on that. So think in terms of at least an $80,000 or more price point.
Very good. Thank you for the clarification, Roger. Okay.
Good. Just some other general things on our loan offerings here. Most states we can lend up to 60%. And we have 20-year fixed, and we've got 25-year adjustable rate loans. 5 units plus in vacation rentals, as you see on the right half of this slide, we lend 50%, and on multifamily 8-10 units, it's a 50% loan. And a quick point, there's not many lenders in this space that will do vacation rentals. We do. And so we're doing quite a few vacation rentals, let's say in the Florida region, some areas of coastal regions of the Carolinas, Texas, California. So be aware, we can do a 50% loan. Property costs $300,000, for example. We can lend $150,000 on a short-term vacation rental that maybe you're going to run as an Airbnb or VRBO platform.
What is your current interest rate on some of these loan programs?
So if it's a 1 to 4 family, 1 to 4 family, it's basically I've got a 3, 5, and 10-year adjustable. That rate on my 3-year arm is 5.5%, 5.5. I have a 5-year arm at 5.875. It's 5 7/8, and a 10-year arm at 6 3/8. So those are all fully amortized 25-year loans. So from the mid 5s to the low 6s, I've got my adjustables, and that's a 25-year term. So with that longer term, you typically get a little better cash flow. Then I also offer a 20-year fixed at 6 3/4%. On the commercial side, you can basically add 1% to these rates. So for example, on a commercial property, let's say you got a little strip center or office warehouse, that rate would start at 6.5, for example, on my 3-year arm, 6 7/8 on my 5-year, and so on. So we have a 1% interest rate premium on commercial and 5-unit plus residential. So just be aware of that, but generally our loans are going to range between 5.5 and 6 3/4%. There's no prepayment penalty on any of our loans, so you can always pay off early or pay down quicker if you want to accelerate some principal payments. And again, these slides here just cover a couple of those things that we talked about earlier. Here's one thing to think about. You know, we finance quite a lot of condos and townhomes, and we do want to look at the HOA financials because the health or lack thereof of that HOA is very important, because that's what's going to replace the roofs and keep the external parts of that complex together. So we'll look at a couple of years of HOA financials. Debt service coverage, I touched on that earlier. I said we want to finance just positive cash flow properties. So here is an example of one that, and it's pretty common. You got a $100,000 property. We lend $60,000 on it, which is 60% of purchase price. On this one, for example, after subtracting taxes, insurance, vacancy management, and any other fees out of it, the net operating income was $7,360 a year. In this case, the client took out a 25-year, 3-year arm, 5.5% interest rate. Payments are $4,421. So how you just look at that ratio is you take your net operating income of $7,360, which is take gross rents, subtract your basic operating expenses, now your net operating income. You take that and you divide it by your loan payments, P&I, and that number just needs to be 1.25 or better, meaning your net operating income has to be 125% of the principal and interest. In this case, it was 1.66. That's all good. Here's another one we did on a piece of commercial property. Purchase price on it was $600,000. Client put $300,000 down. We lent $300,000. This one, they took our rate at 6.5%. On $300,000, their annual payments were $26,841. Now look over on the right half of the screen, and this is our basic cost net operating income exercise we go through. So in this case, this client had a triple net lease with their tenant at $5,000 a month. So 5,000 a month times 12 at gross annual income of $60,000. We always build in a 7% vacancy factor, which basically represents 1 month a year that the property would not be leased. Pretty conservative way to look at that. So build that into your model when you're looking at stuff. In this case, the tenant paid taxes, insurance, and maintenance. It was a triple net. So we didn't allocate anything to taxes and insurance. On a residential deal, this would be a good example where you build in then your taxes and you build in your insurance. Maintenance, the owner had to pay a certain percentage of certain maintenances, so that was included. No HOA, the tenant paid all utilities, and that's the case with most rental properties. And then this one, there was an 8% management fee, so 8% of the $60,000, $4,800. So you took the $60,000 gross income, subtract out those three basic expenses, and that brought you to net operating income of $47,400 a year. So then what we're looking at, there you go. You take that net operating income, $47,400, you divide it by the $26,800 in debt service, and you get a debt service coverage of 1.76. In other words, that's a good loan. That's a good return. It exceeds that 1.25 minimum. And again, this is an actual commercial building deal we financed. And so you can use this basic computation on the right half of your screen on any property that you want to look at. Figure your gross income, pull your expenses out. Now you're at net operating income. Divide that by your debt service. It just has to be 125% of debt service. So this is how we measure cash flow.
Roger, I do have a question.
Yeah.
Okay, my question associated with the debt service coverage ratio, if I could explain it in another way, especially for my investor members, this formula to some people may be a little bit overwhelming, but let me take it from another mathematical example.
Yep.
For example, we're promoting new constructions, single-family homes in Central Florida and in Austin, Texas, and other parts of Texas, whereby I use the rule like 1% rule. That means 1% is the multiplied by the purchase price. That's the big picture I use to help our investors to calculate cap rates and cash on cash return on all those kind of things. So
sure.
the properties, the single family home new construction that we're promoting in those two areas, as I mentioned, are like, for example, $200,000, and it rents for like $1,650, maybe $1,700. That's in Central Florida. In Austin, above Austin, we're presenting homes like 180K, single family home new build, renting for like $1,600. So that should, all else being equal, that should meet your criteria of debt service coverage ratio.
It will.
And, yeah.
It will. I don't see any issue with that. The only thing that I would just say is about Texas is they do have some pretty hefty property taxes, and that can dent the return a little bit. It's not going to throw it out of where it wouldn't qualify for a loan. No, if the kind of ratios and metric you're looking at, C-Wing, are shooting for that 1% rent to price ratio, you're going to be in fine shape. Or if they're getting $1,600 a month out of a $200,000 property, it's going to work. Where I see the process not working so well is like in California, which is why a lot of your investors are going elsewhere to buy, because you might have a $500,000 property in California, but you can't get $5,000 a month rent out of it. You might get $2,000 or $2,400, and that won't hit that metric. So where
That's
you're
right.
going, the prices you offer, the product you're offering, I would tell you based on my knowledge, what I would see, that's not going to be an issue hitting this.
That's right. Everybody's buying outside California in investment wise. All right. Okay.
They really are. Yep. You got it.
Yeah.
Couple things. We've been doing this again over 10 years. We got into this sector in 2008, so we do have a wealth of experience in this world of non-recourse. And I work with all the major custodians and providers of self-directed plans. Generally, if you call here, you're going to talk to me, Roger St. Pierre. I'm the senior VP here and also the underwriter. Also, Nick Conway is my counterpart here at the bank. And so you could talk to either one of us. And we've got a wealth of expertise. But that's the basic presentation that I have, Siwing. Is there any other question or questions that you would like me to cover while we're here today?
No question, Roger. A very well, thorough presentation, very easy to understand, and we have a right fit, definitely. Many of our investors have been buying investment property with the IRAs, and some have been doing non-recourse lending, and we have used another non-recourse lender in the past, but it's always nice to have several other choices. So your company comes to mind since you and I go back several years now. So yeah, I mean, your product fit into what we try to do with respect to our investors in terms of buying out-of-state properties with the IRA. So very good presentation, and looking forward to do business together, Roger.
Thank you so much. I really do appreciate the opportunity to speak to your investor pool today. And I just wish you all good luck and success in your investing. And if there's anything I can do, please get a hold of me. And thank you again, and have a great day.
Thank you so much, Roger. You too.
All right.
Have a nice day.
You too. Bye-bye.